Hey everyone, welcome back to Corporate Dakota, the place where we unpack the juicy details that most financial news outlets either miss or gloss over. Today, we're diving into Atlanticus Holdings Corporation's latest quarterly report, and let's just say it's a mixed bag that tells a story about how they're navigating a tricky financial landscape. Atlanticus Holdings is a financial technology company that aims to help people who might not get loans from typical big banks. They work with other banks to offer credit cards and loans, often through retailers or healthcare providers. They also have an auto financing business. Think of them as a behind-the-scenes tech provider for lenders, making it easier for more people to get credit. How are they actually doing? Let's look at the numbers. First off, let's peek at their balance sheet, which is like a snapshot of what the company owns and owes. As of June 30, 2025, their total assets stand at about $3.6 billion. That's a significant chunk of change. What's interesting is how much of that is in loans. They have loans at fair to fund their operations is a key point to watch. Now, let's look at how much money they made and how that breaks down. For the second quarter of 2025, their total operating revenue and other income jumped to over $380 million, a nice increase from about $315 million in the same period last year. This growth is largely driven by their consumer loan business, where revenue increased significantly, especially in fees and related income on earning assets. However, a major item that impacts their profitability is the changes in fair value of loans. This line item shows a loss of over $21.5 their consumer loan business, where revenue increased $6 million they experienced last year. Why does this matter? Because this change in fair value reflects how the market is valuing their loan portfolios, and a loss here means the estimated future value of those loans has decreased. It's like saying the loans they own are worth less today than they were yesterday, according to their valuation models. This significantly impacts their net income. For example, their net margin, which is what's left after you subtract expenses and the changes in loan values, was about $22 million for the quarter. That's up from $90 million last year, showing that despite the hit from fair value changes, their core operations are bringing in more money. The good news is their provision for credit losses, which is money set aside for loans that might not get paid back, actually went down. It was a negative one for the quarter compared to a negative $1.7 million expense for the quarter compared to a negative $1.7 million expense last year. This might sound small, but it suggests they are seeing slightly better credit performance or are less worried about defaults in their auto finance segment. However, that fair value loss is a big story. The company explains these fair value changes using things like credit loss estimates and expected payment rates. They're essentially trying to predict future cash from these loans when these predictions change. Their reported income changes. The report mentions that growth in their private label credit receivables, which tend to have lower yields but also less risk due to partner agreements, is affecting their overall gross yield net of finance charge-offs. This means while they might be acquiring more loans, the average profitability per loan might be lower. On the expense side, operating expenses increased by about $20 million for the quarter, mainly due to higher salaries, more card and loan servicing costs, and increased marketing. The marketing costs shot up by over $11 million, largely because they're acquiring more customers, which is good for growth, but it costs money to find them. Despite these ups and downs, net income available to common shareholders was around $28 million for the quarter, a solid increase from nearly $18 million in the same quarter last year. This shows that even with the fair value adjustments and higher operating costs, their core business is still generating more profit. However, we need to be cautious. This report also highlights some significant risks. A major risk is their heavy reliance on payments from their loan investments. If people can't repay or if their estimates of future payments are off, it directly impacts their income. They admit that much of their reported income is based on these future estimates, and if those estimates are wrong, their profits could swing wildly. Remember that $216 million loss in fair value, that's a direct consequence of these estimates. They also operate in a heavily regulated industry. Changes in consumer protection laws, privacy regulations, or how loans are classified could force them to change their business practices, increase costs, or even limit their ability to collect money. They specifically mention evolving case law around who the true lender is in loan agreements, which could mean their loans might be subject to different state laws, potentially making some loans uncollectible or limiting the fees they can charge. This is a significant risk. Another key point is their reliance on borrowed funds. They finance most of their loan purchases with debt. If they can't get enough funding or if the cost of borrowing goes up, it directly limits their ability to grow, which is pretty much essential for a financial company like this. They mention their revolving credit facilities, many of which are large and have upcoming maturity dates, and while they seem confident they can refinance, any disruption in the capital markets could be a major problem. Looking at their non-GAAP numbers, which are meant to give a clearer picture of their managed loan portfolios, we see that their total managed yield ratio for the cash segment was about 39.1% for the quarter. This is their estimated return on the loans they manage. However, the combined principal net charge-off ratio, which is how much they're losing from bad loans, also saw an increase, particularly in the first half of 2024, though it improved more recently. The company notes that a shift towards private label credit receivables, which have lower yields, but also lower risk, is influencing these ratios. For their auto finance segment, the picture is a bit different. The managed receivables are much smaller at around $106 million. Their total ratio for auto due to issues at some dealerships while they are working to rebuild their auto loan portfolio. It's a much smaller part of their overall business. One thing that really stands out is the fair value of their loans. They elect to report many of their loans at fair value, meaning their reported income can swing based on market estimates of those loans' future worth. This can make their reported profits look more volatile than they might be if they used a different accounting method. They had a net loss of over $216 million in the fair value of loans this quarter. This is a significant figure that directly impacts their reported earnings, even if the underlying cash collections are more stable. It's a reminder that accounting for financial assets can be quite complex and influential on reported results. Now for a bit of insider info. A large chunk of their common stock is controlled by their executives, directors, and related parties. This concentration of ownership means these insiders could have significant influence over company decisions, which can be both good for stability and potentially bad if it stifles new ideas or activist investors. So wrapping it all up, Atlanticus is growing its loan portfolio and its core operations are generating more revenue than before. However, they are heavily reliant on borrowed money, face significant regulatory scrutiny, and their reported profitability is heavily influenced by accounting estimates related to the future value of their loans. The increased marketing spend and the shift towards lower yield private label loans are strategic choices that need to pay off to justify the costs. The biggest risks seem to be around their funding access and navigating the complex web of financial regulations. They're playing a growth game but with noticeable financial leverage and regulatory tightropes to walk. What's your take on Atlanticus' strategy and these numbers? Do you think their growth is sustainable or are the risks too high? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button. It really helps the channel. And subscribe if you want more deep dives like this. Don't forget to join our Discord community, linked in the description, where we discuss these filings and more. Thanks for watching and we'll see you in the next one.